For over a decade, one story has been repeated so many times that almost nobody questions it anymore. Amazon killed Toys R Us. It's a clean story, a comforting story even. A giant toy store, slow to adapt, crushed by a faster, smarter internet giant. Book it, move on, blame the algorithm. But that story is wrong, or at least it's dangerously incomplete, because 18 months before Toys R Us filed for bankruptcy in 2017, the company was still one of the largest, most recognized toy retailers on Earth, with over 1,600 stores, a globally beloved mascot, and billions of dollars in annual sales. It wasn't losing to Amazon on merchandise, or on foot traffic, or on brand loyalty. It was losing to something almost nobody outside of Wall Street ever saw: a financial structure quietly built in 2005, designed not to help the company grow, but to extract value from it, no matter what happened to the business itself. Toys R Us didn't die of natural causes. It died of a very specific, very deliberate wound inflicted 12 years before anyone declared it dead, and the people who inflicted it walked away having lost almost nothing. This is the real story of how three of the most powerful investment firms in the world took one of America's most iconic retailers and quietly bled it to death. To understand what happened to Toys R Us, you have to go back to a time when the name meant something enormous. Founded in the 1950s and built into a nationwide empire through the following decades, Toys R Us pioneered something retail had never really seen before: the toy supermarket. Instead of a cramped shop with a few shelves of dolls and toy trucks, Toys R Us built massive warehouse-style stores, stacked floor to ceiling with almost every toy a kid could imagine. Walking through the doors under that giant Geoffrey the Giraffe sign wasn't just shopping. For millions of American kids, it was an event. By the 1980s and 90s, Toys R Us wasn't just a toy store, it was the toy store. It dominated the category so completely that toy manufacturers built their entire release calendars around what Toys R Us wanted on its shelves. If you didn't carry your product, you didn't have a toy business. But dominance breeds complacency, and by the early 2000s, cracks were forming. Big box competitors like Walmart and Target had realized something painful for Toys R Us. Toys didn't need their own dedicated superstore. They could be an aisle, a loss leader used to pull in parents who'd then fill their cart with groceries, electronics, and clothes. Walmart and Target could sell toys cheaper because toys weren't their business. They were bait. Toys R Us started losing ground, not collapsing, losing ground. Its stock price sagged. Analysts questioned its future, and in the world of public companies, a sagging stock price with strong underlying assets, real estate, inventory, a globally known brand, makes a company something very specific in the eyes of Wall Street: a target. That's when three buyers appeared. In March 2005, Toys R Us announced it had agreed to be acquired by an investment group made up of three very different players: KKR, one of the pioneers of the leveraged buyout; Bain Capital, a private equity giant known for restructuring retailers; and Vornado Realty Trust, a real estate investment firm with a sharp eye for undervalued property. The price tag? $6.6 billion. On paper, this looked like a rescue, a vote of confidence. Three powerhouse investors believed in Toys R Us enough to bet billions on its future. But look closer at how that $6.6 billion was actually paid for, and the story changes completely. The three buyers put in roughly $1.3 to $1.6 billion of their own money combined. The rest, more than $5 billion, was borrowed. And here's the part that almost never makes it into the headlines. That debt wasn't placed on KKR, Bain, or Vornado. It was placed directly onto Toys R Us itself. This is the core mechanic of a leveraged buyout, and it's worth sitting with for a moment because it's the entire engine of what happened next. In a leveraged buyout, the buyers use the target company's own future earnings and assets as collateral to borrow the majority of the purchase price. The company being bought is the one that ends up owing the debt, not the investors who orchestrated the deal. Toys R Us, a company that had been generating solid profits and had zero involvement in creating this transaction's debt, woke up one morning owing more than $5 billion it didn't owe the day before. And immediately the extraction began. As part of the deal, KKR, Bain, and Vornado signed an advisory agreement with Toys R Us, an agreement that it required the company to pay its own new owners millions of dollars every year in advisory fees, starting at $15 million annually and increasing 5% every single year for as long as they wanted. In the very first year of the buyout alone, Toys R Us paid out roughly $81 million in fees connected to financing the deal that had just buried it in debt. Think about what that means. The company was being charged by its own owners for the privilege of being loaded up with debt. From the outside, nothing looked wrong yet. Stores stayed open, the giraffe still smiled from the sign out front, kids still ran down the aisles, but underneath the floor, the foundation had already been quietly cracked.
Here's what a $5 billion debt load actually does to a retail company, month after month, year after year. It doesn't destroy it in one dramatic moment. It strangles it slowly. Toys R Us now had to make massive interest payments on that debt every single year. Reports place the figure at roughly $400 million annually just to service what it owed. $400 million a year that didn't go toward better stores, better technology, better prices, or better pay for employees. It went straight to creditors to keep the structure from collapsing. And that number matters enormously when you put it next to what was happening in the wider retail world at exactly the same time. This was the era Amazon was quietly building the infrastructure that would come to dominate American retail. Fast shipping, endless selection, aggressive pricing, a seamless website. Every retailer in America was under pressure to invest in e-commerce, in better logistics, in modernizing the in-store experience. Every retailer needed capital to compete. Toys R Us needed that capital more than almost anyone and had almost none of it to spend because 30 to 40% of its potential investment capacity was being swallowed by debt service payments that existed purely because of a financial transaction its own executives had barely any hand in choosing. While Amazon was reinvesting billions into next-day delivery and Walmart was pouring resources into modernizing its e-commerce backend, Toys R Us was left running the same stores, the same aging systems on a shoestring because the money that should have funded that transformation was already spoken for. This is the part of the story that gets erased when people say Amazon killed Toys R Us. It's not that Amazon didn't compete hard. It did. It's that Toys R Us was sent into that fight with one hand tied behind its back by the very people who were supposed to be steering the ship. There were attempts to escape. In 2010, with the debt still looming and sales sliding, the company's owners tried to take Toys R Us public again, hoping an IPO could raise fresh capital and give them a way to cash out. It didn't work. Weak sales and investor skepticism killed the plan, and the company remained trapped under the same structure. Year after year, the pattern repeated. Store conditions slowly aged. Competitors' apps got smoother, while Toys R Us's online presence lagged. Employee morale and staffing suffered as costs were squeezed from every possible corner, except the one place squeezing hardest, the debt. By September 2017, the pressure became impossible to sustain. Toys R Us filed for Chapter 11 bankruptcy protection, carrying roughly $5 billion in long-term debt. Executives insisted publicly that this wasn't the end, that Chapter 11 would give them room to restructure and come back stronger for the crucial holiday season. It didn't work out that way. Suppliers, spooked by the bankruptcy filing, tightened terms or pulled back entirely, afraid they wouldn't get paid. Without full shelves heading into the most important shopping season of the year, sales cratered even further. The very act of trying to save the company through the bankruptcy process ended up accelerating its collapse.
By March 2018, the outcome that once felt unthinkable became official. Toys R Us announced it would liquidate its entire U.S. business, every single one of its roughly 735 American stores. Around 30,000 employees lost their jobs, many of them people who had worked the floors of those stores for years, some for decades. Initially received little to no severance because in the bankruptcy pecking order, ordinary workers rank far below the creditors that the original leveraged buyout had created. The public backlash was so severe that under pressure, KKR and Bain Capital eventually contributed to hardship funds for laid-off employees, a gesture that arrived only after the damage and only after public outrage forced their hand. And what happened to the architects of the deal? KKR, Bain, and Vornado. They had already collected over a decade of advisory fees, transaction fees, and other payments from Toys R Us, tens of millions of dollars each, paid out by the very company their debt was slowly suffocating. When the end finally came, their financial exposure was a fraction of what employee employees, suppliers, and the broader Toys R Us ecosystem lost overnight. So when people say Amazon killed Toys R Us, what they're really doing is looking at the last domino and mistaking it for the finger that pushed the first one. Amazon was real competition. So was Walmart. So was Target. But competition doesn't usually kill a company with a billion-dollar brand and over 1,000 stores in 18 months flat. What kills a company that fast is a decade of being unable to invest in itself because more than $5 billion of debt it never asked for, tied to a deal it didn't choose, was quietly draining it dry, one interest payment at a time. The lesson here isn't really about toys or even about retail. It's about ownership and about who actually bears the risk when a company changes hands. In a leveraged buyout, the buyers can walk away from a failure having risked comparatively little of their own capital, while the company itself, its employees, its suppliers, its customers, absorbs almost the entire cost if things go wrong. Toys R Us wasn't a company that failed to adapt. It was a company that was never given the resources to adapt, because those resources had already been claimed before the fight even started. The giraffe didn't fall because a smarter competitor outran him. He fell because someone tied his legs together in 2005 and spent the next 12 years collecting fees while he tried to run anyway.